You're going on a vacation for 2 weeks. Recently, you have received a brochure that says that they protect your car round the clock 24/7 with CCTV, with security guards and biometric access. You are immediately impressed. And then you call for the service. The valet guy comes, gives you a shiny token, takes the car, and the valet guy parks the car to the garage where this secure system is there. However, the garage person comes and instead of parking the car inside, takes it and gives it out on a rent and wants you on a quick buck until you come back from vacation. Doesn't this sound horrid? You will be surprised to know that what we just discussed is fully legal and acceptable in the world of gold and silver ETF. You have what is called as the authorized participant. Wait and hear more. There are three parties you need to understand in this long-term parking game. First, Midas. That's the brand you see in the brochure. The one that takes your booking, collects your car, and promises to return it safely. Second, the custodian garage. This is the high security facility with cameras, alarms, biometric locks, the place where your car is actually stored. Third, and the most important aspect of today's discussion, the AP garage parking services. They are the middlemen who take your car from Midas Valet and park it in the custodian's lot. In today's session, if there's one thing you will learn, it is the role of the authorized participants, AP, a role that is common in the vocabulary of financial institutions, but not so much for the retail investors. Wait till the end to understand the power they hold on what can happen to a mundane task such as buying gold or silver via ETF. What it can lead to is definitely not something a common retail investor can even guess and anticipate. They handle the movement, the paperwork, and sometimes a few side rentals. In the gold and silver ETF world, these three become Midas, the ETF company, the custodian, the vault that stores the metal, and the AP, the financial intermediary that connects the two and called as the authorized participants. Now assume all the cars have the same look and feel, both on the outside and the inside, and there are no odometers. Now here's where the story takes a turn. The AP Garage Parking Services doesn't actually own your car. It simply manages the parking inside the custodian garage on behalf of Midas. But since all the cars in the lot look identical, the AP figures out a clever way to earn a little extra. It quietly rents out a few cars to the drivers for short trips, promising to bring them back before Midas customer asks for the vehicle. The custodian garage keeps track of how many cars are parked and how many are temporarily handed over to the AP staff. But since every car looks the same, the paperwork always balances. So, on paper, every car is accounted for. In reality, some are constantly on the move, generating side income. That's exactly how it works in the world of gold and silver ETFs. Everything looks perfect in the books, yet underneath, some of that parked gold is quietly out on loan, earning a return for someone else, the authorized participant. Now, every few months, there's an audit day at the custodian garage. Inspectors arrive with clipboards to count every car, check the logs, and verify that everything matches what's on paper. The AP Garage Parking Services knows exactly when these audits will happen. They are pre-scheduled, no surprise visits. So just before the auditors show up, the AP quickly borrows or recalls the cars it had rented out. It makes sure every parking slot is full and tallies with a count that is present with the custodian garage. The inspector nods in approval, everything checks out perfectly, the audit is passed. But the moment inspectors leave, the AP resumes business as usual. Renting, swapping, and moving cars again. So, on paper, the garage looks pristine. In practice, the cars are in constant motion, legal, timed perfectly, and entirely within the rules. That's what ETF audits are like in the gold and silver world. Snapshot inspections, not continuous surveillance. They confirm what's in the vault at that moment, but not what happens in spaces between the audit. An audit in finance is like parking inspection. It proves the cars are there today, not that they stayed there yesterday. Now imagine this. Suddenly, several Midas customers return from vacation at the same time, each asking for their car back. But there's a problem. Most of these cars are still out on rent, driven by others, scattered across the city. The AP Garage parking services scrambles to recall them. But demand for cars is so high that no one wants to return theirs. There's no way to borrow or lease replacements fast enough. So, by disappointing Midas and customers, the AP takes another route. It starts selling some of its other assets, like pieces of real estate bonds, corporate bonds, stocks it owns, to raise quick cash. With that cash, AP goes ahead and buys brand new cars from the open market to fill the parking lots that corresponds to Midas customers. But because everyone else is doing the same thing, the price of cars shoots up. The prices of cars shoots up because every other AP is playing the same game. And at that same time, the value of the other assets being sold collapses. When investors start selling their Midas Gold ETF units, Midas owes them cash, not gold. To pay that cash, the AP Garage service must raise money fast. The quickest way? Sell some of the gold parked in the custodian garage. But that's not always enough. So the AP, the authorized participants, also start selling other assets it owns, stocks, bonds, and real estate funds. Anything that can be quickly converted into cash. Now here is the catch. Multiply that across several authorized participants all doing the same thing. When all of them sell their gold, which are there in the garage, and the various bonds, stocks, and real estate funds, in a blink of an eye, gold prices dip because of the sudden selling. And at the same time, stock and bond markets also tumble because those assets are being dumped to cover redemptions. It is not because something is wrong with gold or with the companies behind the stocks and bonds. Simply, when everyone is scrambling for cash at once, this will have a direct effect in the ETF NAV of Midas. And hence, as a retail investor in Midas ETFs, you are directly impacted. This is a liquidity freeze crisis. Then, once panic cools and the dust settles, gold, like those few remaining cars, become precious again, and its price surges far more than it started. When authorized participants race to pay back Midas customers, they sell gold first because that is the most liquid, and everything else next. That's why in a crisis, all markets fall together before gold, and finally all of them will race. The origin of the term authorized participants is very interesting. When ETFs were invented in the 1990s, regulators like the SEC in US and later SEBI in India required that only certain qualified institutions could directly create or redeem ETF units with the fund. Why? Because ETFs are designed to be open-ended. Units can be added or removed daily to keep the ETF price close to the value of its underlying assets. Allowing anyone to do this would create chaos. So, regulators limited that privilege to a small pre-approved group of large, well-capitalized firms. These are typically banks and broker-dealers. These firms were therefore called authorized participants. Authorized meaning approved by the ETF issuer and regulators. Participant because they participate in the creation and redemption process. So the name literally means their function. An institution authorized to participate in the ETF creation and redemption mechanism. And yet, here is the irony. These authorized participants, the very institutions chosen for their size, stability, and discipline, found a way to turn a safe and boring job, moving gold bars or index stocks in and out of an ETF, to a high-stakes side gig. A task that was meant to be mechanical, like bookkeeping, became a quiet profit engine through repo lending, swaps, and short-term arbitrage. In the name of efficiency, they discovered how to recycle the same asset multiple times, earning a little extra on every turn of the wheel. Nothing illegal, nothing hidden. Just a sophisticated system where a calm, boring product like a gold ETF secretly fuels some of the busiest trading desks in global finance that can potentially bring down the entire financial system under a perfect storm. History has an uncanny way of repeating itself. In the next section, we will look at the real case study of what we had discussed in this section and also find out what we can do to take advantage should such a situation were to arise. Stay tuned.